Mortgage 101, brought to you by creditsanitizer.com. You have a credit report. It is wrong. What are you doing about it? Mortgage 101. How do mortgage rates work? That's our subject today. How do mortgage rates work? And you may be wondering how we decide on mortgage rates. Obviously, you want to make sure that you get the lowest possible rate, but how are mortgage rates determined, and what can you do to make sure you have a low rate? We're going to talk about it right now. There are several outside factors that affect how mortgage rates are determined today, but you can only control one aspect of your mortgage rate, and that is your own personal factors. Lenders look at your qualifying factors to determine your risk level. The better your qualifying factors, the better the interest rate they'll offer. Mortgage rates begin with the current market rate, so you may wonder how the market affects interest rates. Mortgage rates are affected by the economy, the overall economy. When the economic outlook is good, rates tend to increase, and rates fall when they're not so great. Mortgage rates are determined by many elements, including the inflation rate, the pace of job creation, real job creation, not the ones that they reported last Friday, which were totally bogus, and whether the economy is growing or shrinking. When the economy is doing well, again, borrowers can afford more. The Federal Reserve does not set mortgage rate, but it does affect mortgage rates indirectly. The Fed controls short-term interest rates by increasing them or decreasing them based on the state of the economy. While mortgage rates are not directly tied to Fed rates, when the Fed rate changes, the prime rate for mortgages usually follows suit shortly afterward. Prime rate affects the adjustable rate mortgages and the home equity lines of credit. The Federal Reserve controls short-term interest rates to control the money supply. When the economy is struggling, as has been the case during COVID-19, the Fed lowers rates. These are not the rates given to consumers, but the rates at which banks can borrow money to lend to consumers. When the Fed decides they need to tighten up the money supply, they raise the Fed rate. While this doesn't directly increase mortgage rates, eventually banks and lenders must follow suit to keep up with their cost to borrow money from the Fed. Which personal factors affect your mortgage rate? Well, you certainly cannot control the economic factors of mortgage rates, but you can most definitely control your own personal factors. Let's dive into what you can do to get the best mortgage rate possible, beginning with your credit score. A high credit score means you're less of a risk to lenders. A high credit score shows that you pay your bills on time and do not overextend your credit. When lenders pull your credit, they see you as a responsible borrower with a low risk of default. This leads lenders to give you a better interest rate because you are less of a risk. When you have a low credit score, lenders often change the interest rate significantly because you're at a higher risk of default for the mortgage you're getting. A low credit score indicates you may not pay your bills on time or that you have overextended yourself. The credit score you need depends on the loan program you're using. If you want a conventional loan, you'll need at least a 620 credit score, but if you choose FHA financing, 580 or more credit score for most lenders. Taking steps to check and improve your credit will put you in a better position to get a lower rate from your lender. The next factor you control is your down payment. Before I go on to that, hey, make sure you pay your credit card bills the right way. rsrccpayment.com, rsrccpayment.com. That'll help you pay your credit card bills the right way, even if you pay them off in full every month. rsrccpayment.com. Credit mistakes, rsrcreditmistakes.com. And credit tips, rsrcredittips.com. Down payment. Lenders want to know that you're invested in the home through a down payment and that you aren't borrowing 100% of the funds. The more money you have invested in the home, the less likely you are to default. But we do have the down payment assistance program that allows you to borrow 100%. If you put less than 20% down on a home, your mortgage rate will increase and you'll need to pay mortgage insurance. There are different types of mortgage insurance depending on your loan program. Some are cancelable and some are not. Besides mortgage insurance, if you put down less than 20% on a home, you'll also pay a higher interest rate. You're at a risk of default with a lower down payment, and lenders make up for the risk by charging higher interest rates. If you want to get lower interest rates, rsrbuydown.com, rsrbuydown.com. Loan to value ratio compares the amount of a loan you're hoping to borrow against the appraised value of the property you want to buy. The less money you put down on the home, the higher your LTV becomes, which is a higher risk for the lender. When you put little money of your own into the home, you have less incentive to keep paying the mortgage when times get tough. If you have your own money invested, though, you're more likely to do what's necessary to make good on the debt. Lenders charge higher interest rates when there is a higher risk, which means if you put more money down, you have more to lose. Another factor lenders look at lenders will look at when raising your risk is how you intend to occupy the house. Occupancy. Lenders care whether your home is a primary residence, which means you live there. If the home is a second home, like a vacation home, and finally, if the home is an investment property that you'll rent out to others. Interest rates are usually lowest on primary residences because it's where you live. You're more likely to make your payments on time because you don't want to lose your home. If you have a second home or an investment property and you have financial issues, you're more likely to default on those. Bottom line is that both market and personal factors affect your mortgage. While you can't do anything about market conditions, you can control your personal factors. Improving your credit score and saving for a larger down payment are two of the best ways to improve your chances of securing the best mortgage rates. Be sure to take care of what you can control about mortgage rates by looking closely at your personal factors and make them as good as possible to ensure you get the best interest rates available when applying for a mortgage. Always be sure to work with a licensed mortgage professional like us and get your questions answered. If you have any friends, family, or coworkers looking to buy, sell, or borrow on real estate, can we count on you to introduce them to us?